Chapter number 9, National Income. Now here's the definition given by different people, that is by Marshall, Fisher and Pigou. First of all, what do you mean by national income? So that is the sum of total income obtained from the contribution of four factors of production in national production, that is called our national income. And which are that are rent, wages, interest and profit. So we can say that national income is equal to addition of all these four factors, that is rent plus wages plus interest plus profit. If we talk about the general meaning of national income, we can say the monetary value of the total production in agriculture, industries and service sector, that is all the three sectors in a country during a year, is the national income of that country. For example, if we say that the national income of India is rupees 128 lakh crores, so it means that the goods and services of rupees 128 lakh crores have been produced during 1 year in all the three sectors, that is agriculture, industries and service sector. Now these are the three definitions. The definition given by Marshall, we can say that it is production based because it lays more emphasis on the production of goods and services. Whereas the definition which is given by Fisher, we can say that it is a consumption based definition because it gives more importance to consumption of physical and non-physical goods. And whereas the definition given by Pigou, that is, it is called a money based definition because it put more emphasis on money. Let us see one by one. First one is definition given by Alfred Marshall. The net production of physical, that is tangible, and non-physical, that is the services, things using natural wealth. So natural wealth, that is land, with capital and labor in a country during the year, is the national income of the country. Now as you can see by the definition, it puts more emphasis on the net production of goods and services. So that's why the definition given by Marshall is production oriented. Second definition given by Fisher. The proportion of direct consumption of goods and services by the people of a country during a year is called national income. So here this definition put more emphasis on consumption of physical and non-physical goods and services. So this is consumption oriented definition. And the third definition given by Pigou, that is national income is a of those things, that is goods and services, whose payments have been made done through money or which can be easily presented by money. That is the total income of society along with the foreign income which can be easily measured with the help of money, called our national income. So it emphasizes more on money, that's why it is called a money oriented or money based definition. Now some of the inferences based on various definition. First one is national income is a measurement of income obtained in a definite period of 1 year. That is, whatever national income we are calculating, that is for a period of 1 year. In national income, the final products and services are considered. That is, whatever the final goods are produced, that are only considered for calculating national income. National income is a monetary value of final products and services. It shows the monetary value of the goods and services. National income is calculated after deducting depreciation. That is, depreciation is deducted while calculating national income. Goods and services should be produced or consumed. Either it should be produced or it should be consumed. Now two important terms, that is national income and national product. So when we talk about national income, we can say that the sum of total income obtained from the contribution of four factors of production in national production is the national income. Which are those four factors? That is rent, wages, interest and profit. And if we talk about national product, that is the sum of total production value of final products and services obtained by various factors of production in various sectors, that is agriculture, industries and service sectors, in a year is the national product. So we can say that national product equal to total production of all the three sectors, that is total production of agriculture, industries and service sector. So national income, we can summarize it in rand plus wages plus interest plus profit, and national product we can summarize as total production of agriculture plus industry plus service sector. Circular flow of national income. Now, what do you mean by circular flow of national income? Now, whenever we are talking about circular flow of national income, we are talking about closed economy. We have two types of economy, that is open economy and closed economy. So what is closed economy? The closed economy is the one in which there is no role of foreign trade and government. So such economy has no economic transactions with other countries or with foreign countries. We can say it is a self-dependent or self-reliant country. And if we talk about open economy, so in open economy the foreign trade plays a very important role. Some works are done by the government and economy has import and export relation with other countries. Now as you can see here in the diagram, that is the circular flow of national income in a closed economy. Here it is divided in four main factors, that is a firm produces goods and services with the help of these factors. So here it is divided, or the economy is divided in two main sectors, that is the first one is families or household or consumer sectors, that is owners of factors of production, and second one is the firm or the producing sector, or we can say production unit. Now here a firm produces goods and services with the help of these factors and puts them in the market for selling them. And what does the family do? The family, they purchase these goods and services from the market. Thus the flow of goods and services comes to families from firms. And what does the family do? The family pay money to firms for purchasing goods and services, which is called expenditure, and therefore the flow of money comes back to firms from families, and a firm purchases factor with the help of this money and start the production again and pays to families. So from families to firms, that is called a circular flow of production of income, expenditure of the national income. Now this national income, it can be measured by three ways, that is production method, income method and expenditure method. So the flow from families to firm, the flow from families to firm and from firms to families. So where the goods flow from firm to families and payment, it flows from families to firm. So this is a in closed economy scenario. And in fact there is open economy in which the government has a role to play, because economy shows saving and it has the existence of import and export. So the circular flow, it can be explained on the basis of market in such economy, that is in open economy too. Now these are important concepts of national income. That is, first one is gross domestic product. So gross domestic product means the market value of finished goods and services produced by the citizens of a country and foreign citizens within a country's limit. That is called gross domestic product. Now gross domestic product, we can say that some important facts it has, like in gross domestic product the final product or goods produced within the country's limit boundary by natives or by the foreign citizens or by nature are considered. For example, we can say crude oil. Then the concept of GDP, it is related to the boundary of a country in which the production by citizens of a country in foreign country or income generated by citizens of a country in foreign countries are not considered. That is, it should be, the production should be within the boundaries of the country. Third, for economical comparison of countries and to show the progress of an economy, the diagram of GDPs are used in practice. Second comes net domestic product. Now, net domestic product, we can say that during the process of production, when depreciation of factor is deducted from gross domestic product, that is GDP minus depreciation, so we get net domestic product, and the formula for calculating net domestic product is GDP minus depreciation. And during the process of production, depreciation occurs, and due to use of capital and factor of productions like buildings, equipments or many machinery, etc., what happens, their value decreases, so which is called capital depreciation. Third one is gross national product. Now, gross national product, that is the production done by citizens of a country and foreign citizens within the boundary of a country, is the gross domestic product, while the sum of the value of the citizens of the country produced in a year, that is GNP, that is gross national product. And the production done by citizens of a country within the country or in foreign country is not important here, but the production should be done by the citizens of our country, whether they are producing in our country or they are producing in any foreign country, that does not matter. So the monetary value of goods and services produced by citizens of the country in a year is called gross national product of the country. So in GNP, the value of production of current year is considered and the value of previous year is not considered here. Now in GDP, we consider the income of citizens living in foreign countries is added and the income of foreign citizens living in the country is deducted. So we can say GNP is equal to GDP, that is gross domestic product, plus net income obtained from foreign countries. Net income obtained, that is the total income which we have from foreign countries minus the total payment which we have made to the foreign countries, that is called the net income obtained from foreign countries. And mostly the diagrams of GNP, they are used. Next come is net national product. Now during the process of production, the depreciation of factors of production like machines, building and equipment occurs. And as we know, by the continuation use, what happens, the value of these assets decreases, which is called depreciation or capital depreciation. To find out the net national product, the amount of depreciation is deducted from gross national product, that is from gross national product we deduct the amount of depreciation. So after deducting the depreciation from the monetary value of goods and services produced by citizens of a country, that is called net national product. If you want to write down in formula method, that is GNP, gross national product, minus depreciation. Now the value of production of current year after deducting depreciation from GNP, that is called NNP, that is net national product. And last one is per capita income. Now per capita income, what do you mean by per capita income? That is the average income per individual which is derived by dividing the total national income of a country by the population of that country. So per capita income we get, that is the amount which a per person gets, that is total gross national or the gross national income divided by the total population, that is known as per capita income. Now in per capita income, if it is calculated at current price, so if the per capita income is calculated with the measurement of national income at the price of current year, it is called current price per capita income. And if this is calculated with the measurement of the price of base year, that is a fixed price, then it is called current price per capita income as per fixed price. If per capita income is higher, so we can say that the standard of living of citizens is higher, because if the per capita income, that is the amount of money which a person gets or an individual gets, if it is more, so obviously we can say that the standard of living of that particular person will be higher. Let us take an example. If total income of a country is 60,000 crores and the total population of country in the year is 2 crores, so we can calculate per capita income, that is national income divided by the total population. That is 60 crores divided by 2 crores. So 30,000 is the per capita income of that particular country. Some important facts about per capita income. Per capita income decreases if the growth rate population is higher than the growth rate of national income. Per capita income does not change with the change in the distribution of national income. The per capita income is an average measurement. Per capita income is not true criteria in the inequality of income in a country increases. The true criterion of country's progress is not the national income, but it is the per capita, that is the amount which an individual get. If you want to compare two countries, so the comparison of two countries, it can be done by the per capita income of different countries. And from the per capita income, we can make an assumption regarding the standard of living of people of that particular country. Now, measurement of national income. We have three methods, that is production method, income method, and last one is expenditure method. First one is production method. So production method or output method. So this method of calculating national income has been developed from the definition given by the Marshall, because his definition is production based, Marshall's definition. Now, classification of economy in different sectors. Now, before discussing the important facts, the sum of monetary value of finished goods or services produced in agriculture, industry and service sector, that is national income. Now, first one, classification of economy in different sectors. That is here the economy is classified into various sectors like agriculture, industry, services, mines, construction, transportation, communication, banking, education, etc. Next comes selection of goods and services. So, value of produced goods or services in various parts of economy, only finished goods are counted. Intermediate goods or services are not being calculated over here. Next is services of housewife. So the service of the household work of a housewife is not sold in market, and therefore its monetary value cannot be measured. Thus, it is not considered as national income. Next is self-consumption. So the goods produced for self-consumption, they are not sold in market, so its monetary value cannot be measured, and therefore it is not considered as national income. But as an exception, the food grain for self-consumption of farmers in India, it is considered as national income. Next is defense or police. So there are no market of defense and police services. However, they are not considered in calculation of national income. Next is imputed rent. So when a house is given to someone on rent, the probable rent or the amount of rent which we get, that is called imputed rent. So here we assume that the house in which we live is given to someone on rent, and that value is considered in national income. Next is double counting. Now double counting, it should be removed from national income accounting. That is when the value of one commodity is calculated for more than one time, that is twice or double time it is counted. Okay, so when the value of money one commodity is calculated for more than one time in national income, it brings up over value national income. So it is called double counting. For example, now in national income, the monetary value of both iron and the machine made out of iron during a year are counted. So it is called double counting because machine is indirectly it is made up of iron, which we have already calculated. So because the value of iron is included in the value of machine, thus if we calculate the value of iron and the machines, then value of iron being calculated for 2 times. So there is 2 remedies to avoid double counting. We have 2 methods. That is, first one is to count the value of finished goods only. That is, we'll count only the finished goods production. So in this method, instead of counting the value of goods having half made or interim use, if the monetary value of the machine, which is a finished goods, no work is to be done on it, so that value of iron involved in it is considered. So the problem of double counting can be solved by it. Second one is the value or added method. So in value added method, in production process, when a production of goods goes from one stage to another stage, so its monetary value increases. And if this increased value is drawn out and added in national product, the double counting does not occur. Next is indirect tax and subsidy. So due to inclusion of indirect tax in the market value of goods, the indirect taxes are deducted to find the national product and the subsidy given by government is added. Next is resale. So when a good was produced in the past, its value was counted in the national product, and when it is resold, its value is not counted, but if it is counted, then it will be considered as double counting. Next is to deduct depreciation. So during the process of production, the depreciation related to capital factor is deducted from the national product, that is on all the machines, building, equipments, etc. Now next come is income method. So this method of measuring national income, it is developed from the definition which is given by Pigou. So for measuring national income, the rent, interest, wage and profit income obtained from the 4 factors of production, that is land, labor, capital and entrepreneur, they are added, and the income obtained from foreign countries is added, and the payment which we have done by way of rent, interest, wage or profit for foreign factor used in country, that is deducted. So the important factors of income method: to count the income of factor. So these are the 4 types of income, that is rent, interest, wage and profit. First one is income of rent. So the rent of land and building, it is considered as income, and those who live in their own house may get the income of rent, which is called imputed rent. So the income obtained by way of rights like copyright of a book or patent is also considered as the income. Next is income of interest. So the interest obtained by people on their capital during a year is considered, but the interest obtained from the government is not considered because the state generates income through taxes and it pays it as interest, which means that the money is transferred only. Next is income of wage. So the wage or salary given to laborers for their work during a year, it is considered as an income. And next is income of profit. So the income obtained in the form of profit or dividend by investors or any shareholder, that is also considered as income, and it also includes reserved profit and taxes paid on it. Now there are some of the income which are not considered under this method. So in this method of income, for calculating national income, income is generated by way of gift, reward prize, tip, theft, unemployment allowance, government assistance to elders, lottery, they are not considered in national income. Apart from it, the subsidy given by the government is deducted. Any net foreign income is there, that is export import, it is added. Any income is generated as commission or brokerage on sale of consumable goods, that are also considered. Then the incomes which show flow of production of goods or services in economy, which increase the monetary value of goods in economy, they are also considered. And the income of the second hand goods is not considered. Now, expenditure method. So this method has been developed by the definition or from the definition given by Fisher. That is, the national income is measured by summing up the total monetary expenditure incurred on goods and services by individuals, families, firms and governments during a year. So this method shows the assumption of income is equal to expenditure. Now the main four factors of monetary expenditure are consumption expenditure, investment expenditure, government expenditure and net export expenditure. So first one is consumption expenditure. So it is the expenditure incurred on the consumable goods by the citizens or natives of the country or families and firms. So it includes expenditure on durable goods like TV, scooter, car, etc. Perishable goods like food grains, fruits, vegetables, etc. Services like education, medical treatment, transportation, communication, etc. Investment expenditure. So it includes expenditure incurred on building of a factory, plant and machinery and necessary goods equipment for the profession. Third one is government expenditure. It includes expenditure such as consumption expenditure, investment expenditure, administration expenditure, etc. by central government, state government or any local bodies. Next is net export expenditure. So the expenditure on import of foreign goods by citizens of country is the expenditure of the country, and our export is expenditure incurred on goods by foreign citizens. Therefore, the difference between the export and imports is called net exports, which is included in national income. So we can say the total national income under this method is consumption expenditure plus investment expenditure plus government expenditure plus net export expenditure. Now the expenditure which are not considered in national income. So some of them are second hand goods, pension, transfer expenditure, unemployment allowance, financial assistance to widows, purchase of any old shares, expenditure on use of goods of interim use. Difficulty in calculating national income. Now what difficulty do we face? So the official data of people expenditure cannot be obtained. We cannot get the exact official data of the expenditure data of the public or general people. So therefore it becomes difficult to calculate the national income under this method. Now problems in measuring national income. So there are some of the problems which we face while calculating national income. There is problem of double counting. The same goods is counted twice. Problem of self-consumption. That is, if the goods are produced for the self-consumption, that is also whether to count in national income or not. Problem of depreciation, tax avoidance and tax evasion. Evasion means to hide. The people or the persons, they hide their real income to evade from paying taxes. Illegal income, how to measure the illegal income. Problem of net foreign income and problems in accounting like illiteracy, small scale production sale, barter system, people involved in more than one occupation. But apart from all this, the CSO, it tries to obtain the true national income by counting the income very carefully, we can say. Now monetary income and national or real income. Now what do you mean by monetary national income? So if national income is measured at current price, it is called monetary national income. The national income obtained by multiplying the production of all goods and services with the market price of respective goods and services, that is called monetary national income. But this monetary national income, it is not the real income, because if production in current year is equal to the production in previous year and the prices have doubled in the current year, the national income of current year will be double than that of previous year, so which will not show the true situation. Second one is real national income. So if national income is measured at base year price or any fixed price, it is called real national income. So the national income obtained by multiplying the production of all goods and services with the fixed price of respective goods and services during the year, it is called real national income. Real national income shows the true situation of a country. In fact, the production and market price, that is the current price, both increase, and therefore some increase in national income occurs due to increase in production, and some increase occur due to the increase in price. So due to increase in production, the consumption and standard of living of people can be higher.